Welcome to this explainer. Today, we're diving into the massive, constantly shifting world of alternative asset managers. We are going to look at who truly holds the reins of global wealth in 2026. We're breaking down the absolute titans of the industry right now and finding out exactly how they are fundamentally re-architecting the global economy, basically right before our eyes. To really wrap your head around the sheer scale of the global private equity industry today, just think about this massive, mind-boggling number. $8 trillion. That is the total assets under management globally right now. And you know what's truly wild? Just 5 years ago, that number was exactly half, $4 trillion. Oh, and alongside that, there's currently $2 trillion in dry powder. That's just capital sitting there waiting to be deployed. The firms at the very top of the food chain are responsible for the vast majority of that jaw-dropping growth. So let's meet the big three titans that absolutely dominate this space. Blackstone sits completely alone at the top, managing a staggering $1.3 trillion. Then you've got Apollo Global Management, which is rapidly closing in on the $1 trillion mark at $938 billion. And right behind them is KKR at $744 billion. Just those top 5 alternative asset managers put together, they control over $4 trillion alone. But this brings up a super fascinating question, right? If you have over $1 trillion to deploy, what exactly are you buying in 2026? I mean, when a single firm's wealth rivals the GDP of entire nations, the old school rulebook of just buying and selling mid-sized companies doesn't really scale anymore. You have to hunt for much bigger, way more complex game. Part 1, Beyond the Buyout Shop. So when a lot of people hear the phrase private equity, they instantly picture that classic 1980s stereotype, right? Ruthless corporate raiders in suspenders doing highly leveraged buyouts. But the reality in 2026 is entirely different. These firms are now massive multi-strategy platforms powered by perpetual capital. They have huge arms completely dedicated to insurance, infrastructure, real estate, and most importantly, credit. Blackstone's $1.3 trillion portfolio is literally the perfect example of this paradigm shift. Traditional private equity buyouts only make up about 27% of their business today. That's roughly $350 billion. The remaining 73%, that's made up of credit, real estate, infrastructure, and hedge fund solutions. So honestly, when someone says Blackstone is a PE firm, they are really only describing about a quarter of what the company actually does. Which brings us to part 2, the new growth engines. So if traditional buyouts aren't the main event anymore, what exactly is fueling all this unprecedented growth? Well, the answer lies heavily in private credit and retirement services. These two sectors have emerged as the absolute powerhouses for capital formation. Instead of just raising closed-end funds every few years from the same institutional investors, these firms are now securing massive continuous inflows of cash through everyday life insurance premiums and retirement accounts. This means everyday people are unknowingly fueling this massive growth. It's a complete fundamental change in how they source the capital they deploy. Take Apollo, for example. Their traditional private equity business is hovering around $180 billion. But their massive $938 billion total is heavily driven by Athene, which is their retirement and credit platform. Athene brings in insurance premium capital at a scale that traditional private equity fundraising simply cannot match. It allows Apollo to deploy capital across credit and PE strategies without having to constantly knock on the doors of pension funds to raise new equity vehicles. It's brilliant, really. In fact, it's practically an unwritten industry rule in 2026 that every major private equity firm has transformed into a massive credit manager. And it's not just diversification for the sake of diversification. It's a structural migration of returns. With interest rates shifting like they have over the last few years, the ability to structure transactions with credit solutions, like providing loans directly to other companies, has become a massive, indispensable competitive advantage. All right, let's move into part 3, navigating a tougher terrain. The era of cheap, easily levered money, that has completely vanished. Due to a combination of higher purchase prices and wild volatility in the debt capital markets, the average equity contribution required for leveraged buyouts has steadily climbed over time, hitting 36%. That basically means private equity firms have to put way more of their own cash on the line to close a deal today than they ever did in the past. And a 2026 McKinsey report paints a pretty brutal picture of the modern landscape. Assets have literally never been more expensive. The median purchase multiple hit 11.8 times EBITDA, meaning they are paying nearly 12 times a company's core earnings just to acquire it. Because assets are so expensive to buy, they're much harder to sell for a quick profit. Right now, 52% of buyout inventory, we're talking over 16,000 companies globally, have been held for over 4 years. The average hold time is now stretching past 6.5 years. And top quartile buyout returns are sitting at just 8%, while active public markets like the S&P 500 generated an 18% return. The competition is absolutely fierce. As this quote perfectly summarizes, without multiple expansion, which is just a fancy way of saying relying on a booming market to sell a company for a higher valuation than you paid for it, financial engineering just isn't going to cut it anymore. These firms must roll up their sleeves, look under the hood of the companies they buy, and generate true, tangible, operational value if they want to survive. Part 4. The future of platforms. So one of the major keys to their operational survival is without a doubt going to be artificial intelligence. Today, only about 6% of general partners see AI delivering a high impact in their internal operations. But looking just 3 to 5 years out, 70% expect AI to be a high-impact force multiplier. They are heavily banking on AI to sharpen underwriting, accelerate operational improvements, and enable much faster, more disciplined decision-making. Ultimately, surviving this maturing industry requires what you might call a highly specialized survival kit. It requires immense scale and incredibly strict price discipline. It requires an intense, laser focus on actual operational value creation, making the businesses they buy tangibly better. It means tapping into continuous, permanent capital sources, like semi-liquid private equity vehicles, which, by the way, recently saw their fundraising double. And finally, it means embracing complexity. Things like massive take-private deals, pulling public companies off the stock market, and corporate carve-outs, where specialized expertise can unlock value that the public markets completely missed. So what you should really take away from all this is that we are looking at a complete reframing of the industry. We are way past the old era of standalone, episodic dealmakers who relied on cheap leverage to make a quick buck. We are firmly in a new era of massive, institutional, permanent capital platforms that are driving true operational alpha. They are scaling across credit, insurance, and real assets to build unshakable financial moats. Which leaves us with one final, incredibly important question to chew on. As these $8 trillion mega platforms continue to evolve, owning our debt, financing our infrastructure, and managing our retirements, who really holds the power in the global economy today? Thank you so much for joining me for this explainer. I really hope this deep dive gave you a whole new perspective on the financial titans of 2026. Catch you next time.